You know, have you ever felt just completely overwhelmed trying to wade through all those earnings reports the analyst calls just mountains of financial data?
Oh, absolutely.
It feels like trying to find that one key signal in just a whole lot of noise, right? Especially with a giant company, a complex one like Larsen and Toubro.
Yeah, it's a really common challenge. I mean, the sheer volume of information, it can be pretty daunting. But that's exactly what we're trying to do here in this deep dive, isn't it? To
Exactly.
kind of cut through that complexity and get the core understanding straight to you.
Precisely. So today we're taking that deep dive into Larsen and Toubro L&T, as everyone knows them, and we're going to dissect their Q1 FY26 financial results. They just came out July 29th, 2025.
Yep, hot off the press.
Yeah.
And for this session, we've gone, straight to the horse's mouth. We're drawing insights directly from L&T's own materials. The Q1 earnings call transcript, their press release, the analyst
The
presentation,
whole package.
the whole lot. And we've also framed our analysis around some key questions that really help us zero in on what actually matters here.
So our mission is pretty clear. Distill the really important nuggets of knowledge, the key insights from all these official sources. We want to give you a clear, concise picture of L&T's performance, their strategic direction. Basically, a shortcut so you can be genuinely well-informed.
Let's do it. Let's unpack these results.
Okay, so let's start with the big picture then. How did L&T actually perform overall in Q1? Because looking at the headline numbers, it certainly paints a picture of a very strong start to their financial year.
It really does. The figures are quite impressive, actually. Group order inflow, that's the new business they've secured, has shot up 33% year on year. That's 94,453 crore rupees.
Wow, 33%?
Yeah. And then consolidated revenue saw a healthy 16% increase, hitting 63,679 crore. And profit after tax, the PAT, their net profit, climbed a significant 30% to 3,617 crore.
And what's really striking about these numbers, I think, is something L&T themselves pointed out. This is their highest order inflow for Q1 ever, for the whole group.
That's right.
What does achieving a record Q1 inflow like that really tell us about where L&T stands in the market right now?
Well, it's a pretty strong signal, isn't it? It suggests L&T isn't just, holding its own, but maybe even expanding its market share, especially in what's still a competitive environment.
Right.
And this record inflow, it gives them excellent visibility on their future revenue pipeline. It shows robust demand for what they do and a strong competitive edge in landing these big projects. And building on that momentum, their consolidated order book, that's the value of orders they have but haven't executed yet, crossed a really significant milestone.
Okay.
It hit 6.13 trillion. That's 612,761 crore rupees, up 25% year on year.
6 trillion. That's
Yeah.
a huge backlog. And it's not just the core infrastructure side, is it? L&T Finance, their financial services arm, also hit a pretty major milestone.
Indeed it did. L&T Finance's consolidated loan book crossed the euro trillion mark.
Yeah.
And significantly, its retail portfolio now makes up 98% of that total.
98% retail.
Yeah, this kind of near-exclusive focus on retail finance, it typically signals a move towards more stable, less volatile earnings. It sort of de-risks the financial services arm compared to, say, relying heavily on big, chunky project finance.
Makes sense.
And this segment even debuted with investment-grade ratings, BBB, from both S&P and Fitch. That signals strong financial health, good investor confidence.
Okay, so beyond the big numbers, we're also seeing some pretty significant strategic moves, some realignment inside the company. For instance, they've demerged the hydrocarbon segment, split it into offshore and onshore verticals effective April 1st this year. What's your take on that? Does it really boost specialization, or are there, potential pitfalls?
Well, this demerger looks like a clear strategic play. They're aiming for greater specialization, more agility. By separating offshore and onshore, L&T can tailor their strategies, their resources, even how they approach clients, much more precisely to the unique demands of each environment.
Right, different ball games.
Exactly. It's a proactive move, really, to optimize performance in what's a very dynamic energy sector. They want each vertical to be more competitive, more responsive to market shifts.
Hmm.
And speaking of the changing energy landscape, L&T isn't just sticking to traditional energy anymore.
No, that's right. L&T Green Tech, that's a wholly owned subsidiary. They won a pretty significant bid. Build, own, operate a 10 KTPA green hydrogen plant for Indian Oil Corporation's Panipat refinery. And it's a long-term deal, a 25-year contract.
That's a big one.
Yeah, and to support this, and presumably future green hydrogen projects, they've set up 2 new wholly owned subsidiaries just for this. That feels like a major step into the green energy space.
It feels foundational, doesn't it? It really signals L&T's serious commitment to the green energy transition. It positions them as a key player, potentially, in India's emerging hydrogen economy. This isn't just about winning one contract. It feels like it's about building long-term capabilities, a whole new revenue stream in a really high-growth area.
And it's not just green energy either. They're making moves in tech, too. L&T Semiconductor Technologies, another 100% subsidiary, they acquired a power module business from a Japanese corporation working with a local partner. How does that piece fit into the puzzle?
Good question. This acquisition looks like a strategic entry point into the critical semiconductor value chain. Power modules, I mean, they're essential components in everything from electric vehicles to industrial gear.
Everywhere, yeah.
Right. And by acquiring an established business, L&T is positioning itself to capitalize on that global demand for advanced electronics. It diversifies their high-tech manufacturing beyond the traditional heavy engineering base.
And one more thing on the strategic front, ESG finance. L&T became the first Indian corporate to issue an ESG bond under SEBI's new framework. This $5 billion bond, it's not just money, right? It reinforces their commitment to some pretty ambitious environmental targets.
Exactly. Things like water neutrality by 2035, carbon neutrality by 2040. It also positions them as a leader in sustainable finance, which could potentially attract a whole new class of investors who care about these things.
Yeah, that's increasingly important.
And what's also notable here is the company specifically confirmed there's been no deviation in how they're using the funds from these non-convertible debentures, these NCDs. That speaks volumes about their transparency and, their actual commitment to hitting those environmental goals.
Okay, those strategic fifths are fascinating, but let's get back into the weeds a bit. Understand their financial health. We need to dig into the operational details. What really stood out to you regarding their financial efficiency this quarter?
Well, a key highlight, I think, is the significant improvement in their net working capital to revenue ratio.
Right. NWC?
It's exactly. It dropped from 13.9% back in June 2024 down to 10.1% in June 2025. That's a substantial 380 basis points improvement, like a 3.8 percentage point drop.
That's a big move. How'd they manage that?
Management puts it down to strong customer collections over the last 4 quarters, plus timely project execution, getting the cash in the door faster.
Okay, but despite that really impressive Q1 number, management's sticking to their full-year guidance for NWC to revenue at 12%. They mentioned maybe an upgrade later. What's the thinking there? Why so conservative?
It seems like fund constraints in some states are still a bit of a drag, particularly for the GL Jeevan water projects. L&T actually indicated that if you strip out the water segment, their NWC could improve by another 75 basis points.
Ah, okay.
So it suggests that while overall collections are strong, these specific government project funding issues are still, holding the overall number back a bit. What's also positive, though, is the improvement in their return on equity, the ROE, on a trailing 12-month basis. That measures profitability relative to shareholder equity.
And that went up.
Yeah, it increased by 230 basis points to 17% as of June 2025. A nice improvement there.
And cash flow. Always critical, right?
Right.
How did their operational cash flow look?
Cash flow from operations, or CFO, and this is excluding the financial services bit, was really robust. It came in at $62 billion for Q1 FY26.
$62 billion inflow.
Yeah, and that's a huge turnaround from Q1 last year, where they actually had an outflow of $14 billion. So much healthier cash generation, much better operational efficiency this time around.
Okay. Now, looking at overall profitability, the group EBITDA margin was 9.9%. That's actually a little dip from 10.2% the previous year. They mentioned a change in revenue mix with a higher share from the projects in manufacturing or P&M portfolio. Can you unpack that a bit? What does change in revenue mix actually mean for their margins?
Sure. So a change in revenue mix basically implies that a larger chunk of their revenue this quarter came from projects that inherently carry slightly lower profit margins.
Okay.
Maybe some really big projects were secured with tighter margins just to win the bid, that kind of thing.
Right.
It impacts the overall group average margin. What's interesting, though, is that the P&M margins themselves actually remain stable year on year at 7.6%.
So the core segment wasn't less profitable.
Exactly. The slight group-level dip wasn't due to poor performance within that core P&M segment itself. And remember that strong P&M segment itself. Remember that strong P&M growth we talked about earlier?
Yeah, up 30%.
Right. That's reflecting the improved activity levels, yes, but also efficient treasury management. They specifically mentioned getting higher income from better yields on their temporary cash surplus. It's just very disciplined financial management overall.
Okay, so given all these numbers, let's talk about where the growth is actually coming from. That massive order book and the future prospects. They paint a really interesting picture of L&T's strategic focus. How did the order inflow actually break down in Q1?
Right. So the group pulled in $945 billion in total orders. The projects and manufacturing businesses, just on their own, secured a huge $766 billion of that. That's a 41% increase. Yeah, the key contributors there were infrastructure in this carbon light solutions area. But what's particularly noteworthy, especially for their global position, is the international contribution.
You mentioned that earlier.
Yeah, 48% of those Q1 order inflows were international. That's a pretty substantial jump up from 40% last year.
48%. So their global reach is clearly expanding. How does that translate to the overall order book then, geographically? Where are they focusing internationally?
Good question. If you look at that massive 6.13 trillion consolidated order book, it actually looks quite balanced geographically. It's 54% domestic, 46% international.
Okay, almost half and half.
Pretty much. But what's fascinating is the concentration within that international piece. Around 82% of it is from the Middle East.
That 82%, really?
Yeah. The remaining 18% is from the rest of the world. So it clearly shows a very strong strategic focus on the Gulf Cooperation Council, the GCC region.
Okay. And domestically, how does that break down?
Domestically, the order book breakdown is roughly 14% central government, 25% state governments, 34% from PSUs or state-owned corporations, and 27% from the private sector. And overall, about 91% of their total order book comes from just two sectors, infrastructure and energy. Really highlights their core strengths.
That's a very clear picture. Now, looking forward, L&T mentioned a reasonably strong prospects pipeline, 14.8 trillion for the next 9 months of FY26. That number just sounds enormous. A 63% increase year on year.
It is enormous. And this huge increase is mainly led by infrastructure prospects. That's about 7.97 trillion. And the hydrocarbon segments at 5.78 trillion.
Hydrocarbons again?
Yeah. And what's really significant there is the more than 100% increase in hydrocarbon prospects. The primary driver seems to be gas-to-power related opportunities outside India, which ties right back into their green and clean energy ambitions we were talking about.
Right, the transition fuel angle. Now, this brings up a critical point, doesn't it? The domestic versus international dynamic. Domestic order growth seems robust, sure, but it looks relatively smaller compared to that absolutely massive international pipeline you just described. Are we seeing private sector domestic orders finally picking up speed, or is L&T still largely reliant on government projects here at home?
Well, yes, private sector domestic orders are picking up. You see it driven by areas like power BTG, that's the boiler, turbine, generator packages, commercial real estate, data centers are big, hospitals, minerals, and metals.
That's some definite green shoots.
Definitely. However, the expectation is still that the domestic pipeline, in the near term at least, will be almost 75% led by government ordering. Private sector making up the other 25%. Though, they did mention that private investments in new coal-based power plants could potentially shift those ratios a bit in the future.
Interesting caveat. Okay, now let's dive into the performance of L&T's key operational segments. Starting with infrastructure projects, what's the story there?
Okay, infrastructure projects. Order inflows showed, let's say, moderate growth of 2%, coming in at $410 billion. But significantly, 69% of that came from international orders, mainly in renewables and power transmission and distribution, T&D.
69% international for infrastructure orders. Wow. And revenues.
Revenues for this segment grew 7%.
But the EBITDA margin for infrastructure projects was a little bit soft, wasn't it? 5.7% compared to 5.8% last year. What dragged that down slightly?
Yeah, just a touch softer. They said this was primarily due to higher cost pressures on some projects, especially, they mentioned, in the water segment, and mainly driven by time overruns.
Ah, delays costing money.
Exactly. Those delays can rack up costs for labor, materials, even penalties sometimes. Hits the profitability directly.
Okay. Moving over to the energy projects segment. They had some really strong order inflows, you mentioned.
They certainly did. Order inflows here were very robust at $304 billion. That's more than 100% growth year on year. Yep. Benefiting from multiple onshore and offshore hydrocarbon packages, plus those BTG packages for carbon light solutions, and revenues also showed robust growth, up 47%, driven by the execution ramp-up on international hydrocarbon projects.
But the EBITDA margin for energy projects was 7.3%, down from 8.7% previously. How are they explaining that drop?
Right, that's a noticeable drop. The explanation given was an execution ramp-up and a couple of international jobs having competitive margin.
Meaning they bid low to win.
That's the implication. They likely secured these big projects by bidding very aggressively, which means tighter profit margins from the get-go. But they say it's a strategic move, and it was factored into their full-year guidance. And as we discussed earlier, they also highlighted that strategic split into onshore and offshore verticals here, aiming for better focus and agility in this really crucial energy segment.
Got it. Okay, next up, IT and technology services,
Yeah.
LTI Mindtree and the others. What's their performance looking like, especially, given the broader global tech spending environment, which has been a bit choppy?
Well, revenues in this segment grew 10% to $126 billion. They noted this is largely in line with the prevailing global macro environment for IT and tech services spending. So steady growth, maybe not spectacular, but holding its own.
And margins.
The margin variation, however, is attributed to costs incurred towards the newly incubated businesses, things like their digital platforms, the data centers push, semiconductor design.
Investments in the future.
Exactly. It indicates they're putting serious money into building out these future-focused capabilities, which naturally impact short-term margins.
That makes sense. And speaking of data centers, didn't they recently acquire a stake in E2E Networks? Was that related?
That's right, good catch. L&T explicitly stated that the E2E Networks acquisition was done to complement our start into the data center business. They took a 19% equity stake.
So not a full takeover.
No, more like a strategic partnership, it seems, designed to leverage E2E's existing competencies in that fast-growing data center market.
Okay. Now, turning to development projects, this includes things like the Hyderabad Metro and Nabha Power. What's happening there?
Right, Hyderabad Metro, they had a significant fare hike recently, a 30% increase, which apparently nets out to about 20% after discounts.
And the impact?
Positive impact on revenue and margin, despite a temporary dip in ridership. It went from about 4.32 lakh passengers per day down to 4.17 lakh. Management seems to think ridership should start inching back as people get used to the new fares.
What about the break-even prospects for Hyderabad Metro? It's had a tough financial history, hasn't it? Especially the debt.
It has. The management view now is that the project's break-even point should be going around 700,000 ridership per day. So still needs significant growth. But crucially, they're aiming to bring the debt levels down substantially from around 12 trillion down to 8 trillion.
How?
Through a combination of relying on state government interest-free loans and, importantly, monetization efforts, selling off assets or rights related to the metro. That debt reduction is absolutely key for the project's long-term financial viability.
And Nabha Power.
Briefly mentioned, yeah. Its impact was mainly due to a lower plant load factor, the PLF, meaning it just generated less power relative to its full capacity during the period.
Okay. And finally, let's touch on high-tech manufacturing and the other segments. What did we see there?
Pretty strong revenue growth in high-tech manufacturing, actually up 75%. The other segment was up just 1%. Gross drivers were execution ramp-up on orders and also higher handover of residential units in their realty business, which sits in others.
And margins in those segments.
A bit of a mixed bag. Margins were lower in precision engineering, mainly because major jobs are still in the early stages of execution. But margins improved in heavy engineering thanks to operational efficiencies. And the other segment also saw improved margins, helped by that higher contribution from realty and a favorable sales mix overall.
And realty itself, any highlights?
Yeah, the realty business booked new order inflow of $10 billion for the quarter. Their strategic focus remains on key urban areas, Mumbai, Navi Mumbai, Chennai, Bangalore, and the NCR region.
Okay, great. So wrapping things up now, let's look at L&T's overall strategic vision and what they're anticipating for the rest of this financial year. The Lakshya 26 plan keeps coming up, doesn't it?
It does. And they stress that this is the terminal year, the final year of that Lakshya 26 five-year plan. The message was clear. They are on track to achieve or even surpass the specified targets. That consistency, hitting their long-term goals, it sends a strong signal about their operational discipline and their execution capabilities.
And what about those new age businesses? We talked about green energy, semiconductors, data centers. What's the longer-term vision there? Are they still committed?
Absolutely. They continue to reinforce the strategic importance of these areas. Semiconductor, data centers, green energy, digital platforms. They describe them as having been successfully incubated now, and the expectation is that they will contribute meaningfully over the next 5 years.
So it's a real diversification play.
It really reflects that forward-looking strategy, doesn't it? Balancing their traditional strengths in infrastructure and energy with these calculated moves into future high-growth sectors. They're clearly aiming for a more diversified and resilient business portfolio down the road.
So, given all of that, the strong Q1, the strategic moves, the plan, what's the official guidance L&T is actually giving for the full FY26? Did anything change?
No, the guidance for FY26 remains unchanged from what they set out previously. Group order inflows expected to grow 10%, group revenues 15%, net working capital to revenue target is still 12%, and those projects and manufacturing portfolio margins are targeted in the 8.3% to 8.5% range for the full year.
So, confident but realistic, maybe.
Seems like it. It shows confidence based on Q1, but also factors in some realism about ongoing challenges or uncertainties, perhaps.
And what's their take on the wider macroeconomic environment that's going to influence whether they hit those targets?
Well, their summary view is that India is demonstrating resilience. They pointed to strong corporate and bank balance sheets, policy stability, good demographics, digitalization, all helping the domestic economy. Easing inflation and maybe an RBI repo rate cut could provide further tailwinds.
And globally.
Globally, the picture is more subdued, as they put it. Fragmented growth patterns because of geopolitical tensions, policy uncertainties. However, they do expect the GCC region, particularly Saudi Arabia, to continue its strong investment momentum in both physical and digital infrastructure, which aligns perfectly with their huge Middle East order book, right?
Right, that makes sense. So a mixed global outlook, but pretty strong confidence domestically and in their key international market.
That seems to be the assessment, yeah.
Okay, one final really interesting detail that came up in their earnings call was about the labor situation. They talked about a churn of labor people leaving every 3 months or so rather than an outright shortage. How are they actually managing that constant movement of workers? It sounds like a nightmare for project managers.
It does, but it's a fascinating example of adapting to the market reality, isn't it? They said L&T is actively working to mitigate this churn. How? By implementing strategies like using more pre-engineered structures, things built off-site.
Ah, factory-built component.
Exactly. And conducting more work at the factory level before transporting it to the construction sites. Essentially, this means they reduce the amount of complex on-site labor needed for assembly, making operations more efficient and, crucially, less susceptible to the impact of this high labor mobility. They're kind of building resilience right into the project planning stage itself.
Very clever. Okay, so to kind of wrap it all up, L&T has delivered a remarkably robust Q1 for FY26. We've seen strong growth across their core operations. They're clearly making strategic moves, diversifying into these future-ready sectors like green energy and semiconductors. And all the while, they seem to be maintaining pretty disciplined financial management and adapting smartly to market realities like that labor churn.
Yeah, and what's really compelling here, I think, is how the company is pushing forward with these significant investments in both foundational infrastructure, their bread and butter, and these cutting-edge technologies. It really raises an important question, maybe for you listening. In a world that feels increasingly volatile, more uncertain, does L&T's strategy, this balancing act between established strengths and bold moves into new high-growth areas, does that represent a kind of blueprint for future corporate resilience and sustained growth?
That's a great question to leave people with. It certainly makes you think, doesn't it?
Yeah.
About what these kinds of shifts mean for the broader market and maybe how other large companies might need to adapt similar strategies just to stay future ready themselves. Definitely something to mull over.